This is level 1 of the CFA program, the topic on derivatives and the learning module on derivative markets and instruments. This is the first of 10 learning modules under this topic of derivatives. And we're going to have a blast going through these next 10 recordings. We're going to start with an introduction here in this recording, and then we're going to move on through futures contracts and swap contracts and option contracts. And I'm fascinated by the Institute's decision to take what used to be these really long readings in this topic area and condense them down into what it calls learning modules. I think this is great. I think it will have a better learning outcome experience for the level 1 candidates. And I think you'll have a better chance of passing the exam now that we've gone to these modules. Some of the modules have authors and some don't. I'm not sure if that's interesting or not. But what the modules, and in particular this one here has, is what the Institute calls a pre-module learning pre-test. So I think in this one there are 6 questions that it's thinking that you probably already know, and they're relatively simple. So let's go ahead and start with the learning outcome statements. Notice there are just 2 of them for this module. Define and describe. So we'll talk about derivatives in general, and we'll talk about derivative markets in general. So look across the top there. There are lots and lots of derivative securities out there, but I'm going to give you a definition here. This is the one I give my students all the time, and then we'll go ahead and read the definition that's right out of this particular reading. I always tell my students that a derivative security is any kind of financial security whose value depends or is derived from the value of some different security. So we have a forward contract, which is super simple. We have a futures contract, which is nothing more than a standardized forward contract that's traded on some kind of an exchange. Then we have an option, which I think are super fascinating because options have the benefits of the forward and futures contracts. And in many cases, they eliminate the disadvantages of owning a forward or a futures contract. Now, the interesting thing about an option, because it has all of these advantages, is you have to pay for an option. And sometimes options can be quite expensive. And then there are swap contracts, which is essentially 2 individuals looking at each other and saying something like, hey, you know what? The grass is greener on the other side. And so these 2 individuals just swap cash flows from 2 particular assets that those 2 individuals own. So let me read that definition that comes right out of the reading. Financial instrument that derives its performance from the performance of an underlying asset. And that underlying asset can be an individual asset like a share of stock or a bond, or it can be a group of assets like an index. And so there's an example of some of these. Commodities, these are fascinating. Credit derivatives, we talk at length about those in level 2 and even a little bit in level 3. But the focus probably is a forward and a futures and an option and a swap contract excuse me, on relatively simple underlying assets like a share of stock or an index. But let's not be limited to those underlying assets. I mean, here, let me reach in and get my favorite calculator. You guys will see that I love pointing out this calculator all the time. We could have a derivative contract on this particular calculator. You know, you could say, hey, Jim, that's a great calculator. I'm going to take this test, but I'm not going to take this level 1 exam until a year from now. Can you and I enter into a contract under which you would sell me that calculator in 1 year? And I would say, sure, make me an offer. And so it's really just 2 individuals or 2 organizations who are trading an underlying asset. Now, the exchanges are probably not going to trade a derivative on my calculator because the price pretty much goes like this right now. 2022, we've got lots of inflation, but I don't think inflation is that high in the calculator market. So one of the themes of these underlying assets is their volatility. And what we'll learn is that those assets, those underlying assets that have lots of volatility, they make for great underlying assets in the derivative markets. All right, so what happens when in the derivative market? How are they created? So look at that first teardrop point there involving two counterparties. And the two counterparties, they could just be you and I, or they could be two different financial institutions, or they could be two different government bodies. Either way, there's a buyer and a seller. And a derivative contract is a legal and binding contract. And so there are rights and obligations of each party. Now, one of the interesting things that I teach my students in the very beginning of my derivative securities class is that go down to the first check mark there, an individual stock under the equity description of underlying assets. I tell my students, I say, look, you can buy that share of stock today, and you can hold on to it for the rest of your life. And you can bequeath it to your children and your grandchildren and so on and so on. And as long as that corporation is in existence, you could hold that stock, for a super long time, maybe even forever and ever. Not true for derivative securities. They all have either maturity dates or expiration dates. And most of these, with the exception of the swap derivative securities, most of these have short term. In other words, a call option on a share of stock might have a 6 or a 12-month expiration date. A forward contract on the Canadian dollar might have a maturity date of 6 months or 9 months. There might be a futures contract on, let's say, orange juice that might mature in one day. And of course, those of you who pay attention to the movie industry will know that I referred to one of my favorite movies, Trading Places, where Eddie Murphy and Dan Aykroyd traded orange juice futures contracts. Super fun movie to watch. So just like when we show up on the floor of the New York Stock Exchange and we buy a share of stock, that means that we're taking the long position. And that means that we benefit when prices rise, when we take that long position in a share of stock. Now, because the nature of derivative markets are relatively short term, I don't think I said this a few moments ago, but let me pause and say, most swap contracts have a tenor, that's what they call it in the swap market, of 3 or 5 years. So that's kind of long term. But most other derivative contracts, options and futures and forwards, have relatively short time periods. So essentially what's happening is that you have two people, the buyer and the seller, two people who get together and they disagree on the price movement of that underlying asset. So in derivative markets, there always has to be an offsetting short position for the long position. And so just remember it this way. The long position benefits when the price of the underlying security rises. The short position benefits when the price of the underlying security falls. So you just really have two people or two organizations or two institutions who look at each other and they say, you're wrong, and I'm going to bet you on it. Now, of course, we can decide to show up on the New York Stock Exchange and buy 1 share of stock or 10 shares of stock or 100 or 1,000 shares of stock. And so that's true inside of the derivative markets as well. We have what's known as the contract size. We'll refer to that regularly as the notional amount. And the notional amount in almost all cases is really just a reference amount to calculate the profit and loss to the short and long position once that contract either matures or it expires. So the derivative can be a forward obligation. Your reading calls it a commitment. In other words, if we take my financial calculator, where is it? It's just sitting here. So if we had that example from before, you agreed to buy this, I agreed to sell this. So both of us are obligated to show up and fulfill the terms of the obligation. Because it's a legal contract, then we can bring in the court system if one of us doesn't show up at the maturity date of the contract. Or these derivatives can be contingent claims. In other words, let's suppose that something happens in the future. The price of the underlying goes way up or it goes way down. Then we might be obligated to trade, but we have a right. So contingency means that you might have to trade, but then you might not want to trade and you're not obligated to trade. All right, let's go ahead and talk about this creation. And so think about it. When you show up on the floor of the New York Stock Exchange, this is a secondary market. And so those shares of stock have already passed through the primary market. They've already passed through the investment banking institutions' hands, and they're now in the hands of the shareholders. And so what happens on the floor of the New York Stock Exchange is that you have those people who are current shareholders who want to sell their shares, and those people who are not current shareholders and they want to buy those shares. Well, in the derivative market, what you do is you have somebody that shows up that says, I want to create this particular derivative security. And so the seller, the writer of the derivative, actually does the creation. If this is a share of stock, the issuing company is not involved at all. The New York Stock Exchange is not involved. Nobody's involved instead, except for one organization who says, I'm creating this derivative today. So then what happens is that in these forward commitments, like a forward contract or a futures contract, these two people decide, right? We'll say something like, let me go back to my calculator. How much does this calculator cost now? Boy, in the secondary market, I bought this, 25 years ago, even before I went through the CFA program. Who knows how much I could sell this for today? Let's suppose it's $10. So what happens then in a forward commitment is that you might say to me, you know what, Jim, I'll buy that calculator from you in 1 year for $12. I could sell it today for 10 in the spot market, but what we're going to do is you're going to say, I'll pay you 12. And what essentially you're doing, and we'll learn about this as we go through, especially level 2, that you're essentially paying me the extra $2 in the forward market, in the derivative market, to make sure that this is safe. I have 3 boys living in my house, so they could take a sledgehammer to this and crash it over the next year, and then it would be no good, right? That forward contract, that forward commitment, I wouldn't be able to honor it. So you're essentially paying me to deliver, the asset that is described in the spot market. So in my example, we agreed to trade one calculator 1 year from today. And we're going to do it with a settlement. I'm going to hand you the calculator, and you're going to hand me $12. Now, the interesting thing about that is that you've committed to hand me $12. I've committed you to hand the calculator. But what if the price of these things goes up to $112? Well, you're going to be so super excited to make this trade because you're going to buy the calculator from me for $12. And then, you could use it to take the test, or you could go out and sell it for $112. So you're super happy and I'm super sad. So this is the nature of the obligation of these forward commitments. And so notice that third embedded bullet point: forward contracts, futures contracts, and swap contracts. And we'll work through examples throughout level 1, level 2, and level 3. Contingent claims, on the other hand, the payoff actually is determined by the movement, the price movement, or the interest rate movement of the underlying asset over time. And the clear example is a stock option. And so let's go back to my example. And suppose instead of this being a calculator, it was a share of stock. And the price of that share of stock today is $10. And you agree to buy it from me with an option. You have the right but not the obligation to buy it from me. Let's just say $20. So this is known as an out of the money option. And so you're not going to exercise that option today because you can go buy that share of stock for $10 on the floor of the New York Stock Exchange. But you have this derivative contract with me that over the next year you can buy it from me for $20. Well, if the price stays low, you'll just allow the option to expire, right? What do we have? Conditional on some event occurring. But if that price goes up to $100 per share, you're going to show up at my door and say, hey, Jim, here's $20. Hand me that share of stock. And then you can go and sell it on the floor of the New York Stock Exchange for, what did I say, $100, right? So you see how these two things are different. This is a great exam question. The difference between these two. In a forward commitment, you are obligated to trade regardless of what happens to the value of that underlying asset. With a contingent claim, you have the right but not the obligation to trade. So you can allow the contract to expire. You can do nothing. And that's the really cool thing about these contingent claims. And they work for credit derivatives, which we'll talk about mostly in level 2, and asset-backed securities, which show up in all 3 levels. But what you can do is you can do nothing. It would be awesome just to be able to wake up in the morning and just say, I'm not going to do anything. I'm going to do nothing. And so investors, option owners, and other derivative contingent claims owners, they're willing to pay for that option to do nothing. All right, so this is kind of a summary page here of what I've just been talking about. So investors can sell short, right? They can benefit when the price of that underlying asset goes down. What you can do is you can add let's say a futures contract on orange juice as part of search for diversification for the entire portfolio. You can add a swap contract where you're swapping, let's say, a fixed interest rate for a floating interest rate, depending on what you think interest rate paths are going to take over the next 3 or 5 years. You can use these derivatives to offset some kind of market exposure. So this brings us into this concept of hedging. We can create large exposure. There's tremendous leverage in the derivatives market. In fact, I tell my students, I say, look, if you were able to get in a DeLorean and drive 88 miles per hour like Marty did in Back to the Future, I said, just go one day in advance and then get in your car and come back to today. But while you're in the future, pick up a Wall Street Journal and find out what some interest rate is. I don't really care what it is, but maybe it's some short-term interest rate like the secure offered financing rate. Tell me what that interest rate is tomorrow, and then come back and tell me today what it's going to be, and I can turn you into a trillionaire overnight. So there's just tremendous amounts of leverage. And so that means low capital, and you can create large exposure positions. Lots of liquidity on the futures exchange and the options exchange and the swap market, even in the forward market. Low transaction costs. So look at the bottom here. This is another great example of what the Institute can ask you on the exam. So think about a question stem. Here's an investor that wants to do this and this and this. What's the motivation? Hedging, speculating, or arbitrage. So these are the 3 uses. So hedging, it's amazing, and I show my students this all the time, that you can take an underlying security or a position in a portfolio that has this much risk. Can you guys see my hands? That has this much risk, and you can layer it with a derivative, and you can totally eliminate risk. These are called perfect hedges, which we'll talk about sometime in another slide deck. So you can hedge, you can eliminate, or you can reduce risk, or you can speculate, you can increase risk. And then, of course, if you have, let's go back to my orange juice example. Let's suppose in the futures market for orange juice, there's a certain price. But over in the option market, for an option to buy some orange juice at sometime in the future, there's a different price. Well, you can take a long or short position in the futures contract while buying or selling an option in the options market, and to take advantage of those mispricing in either of those 2 markets. Now, take a deep breath along with me, and don't expect me to be able to teach you how to find these arbitrage opportunities as an individual. But those of you who work for for large financial institutions, you'll know some individuals, and maybe even one of you are those individuals who trade hoping to find arbitrage opportunities. But you need tons and tons of money, which financial institutions have, and you need tons and tons of technology, which financial institutions have. And then you need the ability to hit a button when you suspect that there's an arbitrage opportunity out there, and live with that decision. All right, how about the basics of derivative markets? So essentially, it works just like the way the New York Stock Exchange works and the bond exchange works, with a couple of exceptions. And so we have over-the-counter markets. And remember that over-the-counter markets pretty much historically mean those markets that are linked by some measure of technology. But let me give you a little bit of a history lesson. You'll know, those of you who watch my other level 1, and hopefully you'll watch level 2 and level 3 videos in the future. I love history, and I love giving history lessons. So let's go back to, let's say, the year 1890. If you wanted to buy a bond that was issued by the Pacific Railroad Company, you would go down to your financial institution and you would hand over a bunch of money, whatever that bond cost, and the banker would hand you a coupon book. And what you would have to do to get your interest payments is every 6 months you would tear out a coupon and you would come to the financial institution and you would slide it over the counter. You had to actually be there and you had to have possession of that. And so that's why the name over the counter. But, over the years, when we now have computers and handheld stuff and smartphones, now you just press a button. And so that's considered the over the counter market. And so look at this. Here we are. We're the end users. We're the green on the periphery, and there are all of the financial institutions, whatever they are, inside the middle. So end users, we deal with these financial intermediaries, they deal with us, but then they also deal with each other. So look through the block points there. What are some characteristics that might show up on the exam? Non-standardized, customized. So this is super important. That you can go to this over-the-counter market and you could say something like, I want to take the long position in a forward contract because I want to buy 12 HP 12C financial calculators in 13 months. And I want to do it for $187 a calculator. I made these numbers up as I went along, but the important thing is that you think about this, that as good financial analysts or as good wealth advisors, we need to make certain that we know all of our clients' risk and return objectives. And so it might be that we have a unique client that has unique needs. And so we go to the over-the-counter market to deliver those unique needs. Terms of the over-the-counter market can be modified to match a desired risk exposure profile. Oh my gosh, beneficial to hedging. It's also beneficial to speculating. Let me go quickly back to a fixed income security conversation. We learn that in order to immunize a bond portfolio, all we have to do is match the duration of the bond with the investment horizon of the client, and there are some problems with immunization. It's not perfect, but how can we do this? Think about the client. We have a client who has special needs in terms of what their future aspirations are. Well, we can go to the over-the-counter market to do this. Now we can also go to organized exchanges. And so notice the difference between this illustration here. Go back real quickly. This illustration and that illustration is that there's a red box in the middle, and there is an organized exchange or some central counterparty involved in there. So these exchange traded derivatives are standardized. They're fairly highly regulated, which means they have lots and lots of liquidity, lots and lots of transparency, and the terms and conditions are standardized. And so if you want to take the long position in a gasoline futures contract in New York City, well, you have to do it in increments of 42,000 gallons of gas. This is what the exchange has decided is the standard amount. And that contract will mature on the third Friday of some particular month in the future. The exchange gets to pick what those days are, and they're pretty standardized. And if you go to the exchange, you can see all of these terms. Now, I do want to tell you a quick story. Years ago, I took my students to the Philadelphia Stock Exchange, which was fairly exciting. But then we went to the Philadelphia Options Exchange, which has now been taken over by NASDAQ. But we went back into this room, which was probably the size of one of my classrooms, and we saw traders in there, and they were yelling at each other. It was not G-rated conversation, and you could feel the excitement in there, and it was a super experience. Now, this is 20 years ago or so, but it's still super, super exciting. Now, remember I said just a few moments ago, I referenced the Dan Aykroyd and Eddie Murphy movie. Those of you who know Trading Places, you'll note that at the very end, when Dan Aykroyd and Eddie Murphy, they made all of this money, and the Duke brothers, they lost all of this money, and the dude from the exchange comes out and he goes, "You owe us $476 million. You know that accounts are settled every day." So in this exchange traded derivative market, there's something called daily settlement. There's a winner and a loser declared every day, and it's cash settled. And this helps clear all of the trades throughout the day, and it promotes liquidity and transparency and all that good stuff. So here's a good summary page here. So over-the-counter markets offer flexibility and tailorability. This is the word I use, but the reading says customizability. Less transparent, and the over-the-counter market, of course, involves counterparty risk because of you and me trading this calculator. But if we went to the, suppose there was a Hewlett-Packard futures exchange, well, then those things would all be standardized, they would be regulated, and there would be way less counterparty risk. So that takes us through Module 1. And what I want you to do is go look at the end of Module 1. I was a little disappointed. There was only one question, one question stem, and maybe 4 questions in this reading. So this is introductory, and I'm guessing that this was pretty good for you guys. So hopefully nothing too new. But remember, we have 9 more modules to go, so we'll increase in our complexity as we do this. So, hey, thanks for watching and good luck studying.